Welcome to the Market Huddle Plus, episode 22. I'm 𝗪𝗘𝗓𝗓 with our weekly 30-minute catch-up interviews with past guests. This week, I have the pleasure of welcoming back to the show Tavi Costa, portfolio manager at 𝗪𝗘𝗕𝗜𝗓𝗜𝗏 Capital. We're going to take a deep dive into all things macro and, of course, get an update on precious metals. Let's get Tavi on the call. Hey, Tavi, it's great to have you on the show, bud.
Thanks for having me, Patrick. Looking forward to this.
Well, listen, it was the summer of 2019 when was the last time we had you on the show. It's been too long. I'm so glad you're back, and I'd love to get just an update from you on what's going on. Listen, before we get into the topic, which I know many that are tuning in want to hear about on precious metals, I want to talk to you a little bit of just what's going on here on a bigger macro scale. I mean, we have obviously an extraordinary tightening cycle by the central banks. Raised interest rates for the last several years. They're pausing here on that. Everyone thinks their Fed is going to start cutting sooner. Do you think there's recession risks? What's your take on the overall market here and the macro landscape?
Well, as you know very well, it's been very challenging to call the recession. It's the recession call has been probably one of the hardest things to do in the last 12 to 20 months or so. However, there's a profusion of macro indicators still pointing towards that direction, regardless if it is global central bank assets contracting, and which is, I think, diverging significantly now from equities overall. And you've got other very strong leading indicators like yield curve inversions. And I have a metric that I often look at, the unemployment rate that's been surpassing the 2-year moving average, an indicator that has always really predicted recessions in the past. And ISM manufacturing being at a below its 50 level for over 12 months consecutive. I mean, I can go on, and then you've had this tightening of monetary conditions for over 20 months already, which is sort of in line when you should expect seeing some of the impact of that in the overall markets and economy too. VIX being so low, it usually lags the Fed funds rate by about 2 years, actually. And so we're almost into that range of where you should expect some volatility event or some sort of issue emerging here in the U.S. And so I remain very concerned. I think the fact that a recession hasn't happened doesn't necessarily lower the probability of one happening. And to me, this is I think it's noise in terms of equity markets being so overvalued as much as they have been over the last years or so. And the fact that people are expecting all these, extreme, or I should say robust growth of corporate earnings moving forward, to me, it just seems a little bit of an overstatement overall. So, I think there's better opportunities elsewhere in precious metals and hard assets and other businesses that remain historically undervalued that I think I would say that require more attention and require also more capital attention as well, and look much more appealing from a value and macro perspective.
The markets have really been almost fragmented because there's the Magnificent Seven that are bulletproof and just can't keep rising and defying all logic in terms of some of the valuations that they're reaching. But yet it's the trade that is working, and any prudent investor that is looking at things from value or growth and trying to diversify is simply getting chewed up as the performance in the market has not been broad. What do you make of the Mag 7 and where we are and generally in equities? Is there what do you view it as a true bear market risk, or do you view it that the markets are just going to trade more in a sideways range until valuations normalize?
Well, I think that the narrowing leadership that you're referring to is concerning overall, but also we can look at that from a multiple perspective, but also I would maybe point out the capital spending that those companies are doing, which is a change of the nature of their businesses. I mean, they used to be known for companies that have really strong margins and profitability, which is still the case, but didn't require much capital. And now, if you looked at the large capex boom that we've had, which everyone talks about, the fiscal stimulus that we've had overall over the last, call it 3 years or so, but the capex boom has been one of the strongest in history in the U.S. And it's been led mostly by actually infotech. So most of the technology companies, if you include Amazon and Alphabet, which are part of the technology sector, you would see that somewhere close to $200 billion have been spent over this last 12 months, which is higher than energy. It's higher than material sector and other parts of the economy that are supposedly are more capital intensive. It's even higher than utilities. And so, does that change again the cyclicality nature of these businesses because they're requiring more capital to grow? No, I think those are good questions. I think they're becoming more and more long duration companies, and to me, in a higher cost of capital environment, it's becoming more and more challenging to justify these valuations. And so, again, I think that there's a much better reason to be redeploying capital elsewhere. And I don't understand why paying 50 to 100 times earnings to a business in the technology space in the US when you can buy a resource business or just a bank, a traditional bank in Brazil, trading at 5 times earnings that has been established business for over 30 years. I mean, I don't understand what the value and macro proposition of taking that additional risk in this part of the market personally.
Well, it's funny that you mentioned, the cheap valuations on some of these emerging market stocks. And by the way, all of our listeners, if you're not following Tavi on Twitter, give him a follow. He just posts some great content out there. You can follow him at Tavi Costa. Tavi, though, you had this chart on there showing the emerging market equities versus the U.S. equities being at some 50-year lows. And obviously, you're referencing specifically Brazil and some of the opportunities there. And I can't think of someone better to speak about Brazil's market and what's going on over there. So why don't you tell us a little bit about emerging markets and then maybe give us an update on some Brazil and what you're thinking there?
Well, I think it's important to break that down in terms of the weighting that we have, because China is a large weight of that index, and I'm not really bullish in those types of markets, although things have been really oversold if you want to talk short term. But long term, I think investors need to be separating even the BRICS and looking at companies, or I should say countries that have resource rich exposure, and also they're geopolitically neutral relative to places like Russia and so forth. And so Brazil fits into that category in a big way. And looking at the valuations of those Brazilian companies, I can't recall a time when the disconnect between that and U.S. businesses have been so large. And maybe you can justify that by the political leadership and other things, but I think that's mostly in the price already. And so, it's hard to believe we're going to see this world of reshoring economies and especially developed economies and improving affordability of housing in the U.S. and other developed economies too, green revolution and all sorts of things without making the resource industries a lot bigger. And when you think about that, it's a relatively small pocket of the market. As you see institutions really looking for exposure in commodities overall, they are likely to go into other commodity-led economies. And Brazil is one of them. And South America overall certainly is a region that I've been really bullish recently. This is almost in line. The chart you're referring to or shows emerging markets actually trading at one of the lowest levels relative to U.S. equities in the last 50 years is pretty much in line with the commodities to equity ratio. It's pretty much in line with the fact that hard assets are cheap relative to financial assets. It's almost as well in line with the fact that value stocks are cheap relative to growth stocks. And so everything is pretty much aligned. I mean, you're seeing correlations change over the last 2 years or so. Japanese yen used to be a safe haven. It's no longer that. You're seeing gold breaking correlations with real rates. You're seeing the beginning of value starting to outperform growth. You're seeing steep tightening of monetary conditions in Brazilian equities performing very well. Those are all important questions. Are those big changes in markets that were just at the early stages? And I would strongly argue that that is the case. And so, focusing on folks and funds and all others that have the skill set of really navigating those markets, I think are going to be really important things to be an investor here. And so, Brazilian equities is just one way of expressing that view. I think you should avoid some of the state-owned companies and other things. I think you can avoid that easily in finding great businesses that, like I said earlier, that are established for over 3 decades or so and have even dividends. They're even paying dividends today, and you can go even deeper and go into more commodity-related businesses as well that look really attractive. So we've been going even deeper than that and looking for mineral claims and other things, but there are all sorts of ways of really skinning cat here. And so I feel very compelled that this Brazilian equities idea and other investment opportunities in the area are going to play very well in the near future.
Everyone's listening in anticipation of us talking precious metals. So let's talk about that pet rock what's going on here in gold and silver. And it's funny that we're recording this at the time when we had an extraordinary overnight pop and substantial reversals. I mean, gold basically broke out to an all-time new high, at least on the open, and silver broke out, basically retesting its previous highs, just over $26. Not all-time highs, but at least the highs from earlier this year, and quite the intraday reversal. I mean, overall, the charts are incredibly bullish, but why don't you give us your overall precious metals thesis, and then let's talk about some of the miners afterwards.
Sure. Well, look, I think this is we're at the early stages of a big secular movement, and probably the most important one since the 70s. And we had really two big long-term cycles for gold in the last 50 years or so. One was in the 70s during an inflationary era. Central banks were actually accumulating gold at the time, and then you had the early 2000s where it was quite different. Central banks were not really accumulating gold. It was really driven by a commodity markets that was mostly China related, with the entry of the WTO and becoming a manufacturing plant of the global economy and so forth, really drove the prices of tangible assets, and ultimately gold actually went up for about a decade or so. And I think this is sort of, you have kind of both. I think you do have more of an inflationary era today for many reasons: deglobalization, chronic underinvestments in resource industries. You have this labor cost that is I also, in my view, a long-term issue, and the reckless amount of fiscal spending. So being in an inflationary era that is, to me, not similar to the 70s, but somewhat, let's just call it, higher than historical standards in terms of prices of goods or consumer prices overall. If we think it that way, those are times when you want to really own hard assets. You want to own commodities. You want to own gold. And when I look at the two largest pools of capital in the global economy today, which I would call central banks and more, pension funds and other types of more traditional investment strategies, they are completely underallocated towards gold. Yes, central banks have been buying gold recently, but they own, if you think about what they own in terms of their balance sheets, 80% of their international reserves is held by sovereign debt. So you go back to the 70s, at the very peak of the times when they actually were accumulating gold, we had close to 75% of gold overall relative to those international reserves. So there's certainly a lot of room for that to enhance the quality of their balance sheets. And then you think about the investment strategies that are more traditional. There's a reason why we call 60-40, and they don't include gold in those allocations. In fact, there was a good research from Bank of America looking at, basically surveying a bunch of investment advisors, asking them the question of how much gold do you have, how much exposure you have to gold, and 70+% of them essentially said they own 0 to 1%. And in fact, 0% own more than 10% exposure to gold. So, I think, even from a capital dynamic standpoint, that looks quite attractive. And, finally, we're probably in one of the most unique macro environments we've seen as far as what I call the trifecta of macro imbalances. It's a debt problem of the 40s, the inflation of the 70s, and the valuation problem of the late 90s and the late 20s. And so, putting it all together, policymakers are highly constrained. Ultimately, we're going to have to go back to financial repression, and we're talking more long-term, issues. And I think that that's going to translate into higher gold prices. So when I looked at that and I had started to form this view, to me, it was pretty clear that the need for buying assets that have exposure to gold and have leverage to gold prices was probably the most interesting opportunity of the next decade. So, metals and mining overall look kind of the same way. I've never seen a time when gold prices take off and you don't see commodity prices actually, coinciding with those cycles. And so I firmly believe that despite this noise on a daily basis that we have, which, you get very happy on days like last night, and then you wake up on a day like today and it's just brutal. So but the thesis doesn't change. The thesis is still here, and the fact that you can still buy all these businesses so cheaply is really where I get really excited about. And I think a lot of people are dismissing this as an opportunity.
Right. And so let's talk about buying these companies. Now, obviously, you can categorize them as, the larger, more established miners versus a lot the exploration names. You can go directly into silver miners. You can go into royalty companies. There's all sorts of different ways to approach entering the precious metals equity markets. Obviously, the market capitalization of the whole basket is still incredibly small, so you can holistically look at it that way as well. But how do you approach the individual stocks, and what's the opportunities you see here?
Well, for me, the interesting portion was studying which ones are the billionaires of this industry, where they made their capital, and majority of them made their money in exploration, believe it or not. But also when you talk about with institutions about getting exposure to miners, folks will often talk about the GDX members and GDX, the ETF members, and the GDXJ and so forth. But the big opportunity to me are even privately owned companies or very small businesses that have very prolific ground that are likely to find major discoveries. Those are the folks. Regardless if it is Tom Kaplan or Pierre Lassonde or Ross Beatty, most of their capital was made in exploration, if you look back. And so to me, there's a compelling reason as well to create a strategy that really is focused on kind of a hybrid venture capital approach of owning a lot of different companies all over the world in places that we think that they're highly likely to find discoveries. The key here is that the market is so inefficient for many reasons. One, for capital reasons that we've been discussing here. If you look at the depressed CapEx cycle for the overall industry and so forth, but also the fact that we don't have enough geologists. I mean, if you look at charts of even graduate students into geoscience programs and other things, you're going to find that we're also in a secular decline of those types of studies, and it's quite interesting because that's reflected on the way the market has been interpreting data in general. And so we have companies that are putting out incredible data, improving the intrinsic value of those companies, improving the probability of finding a discovery. And the company falls in those events because folks are looking for a liquidity event. And so, this market is completely distressed. And to me, it's a great way for investors like ourselves to take a kind of a long-term approach to accumulate all those great companies. And so or great assets. In some cases, they're not in great hands, but the assets themselves are incredible. And so we've been looking for vehicles to kind of expose ourselves towards that. But there's a lot of issues in the overall mining industry, and there's a reason why it's so distressed. Often people like to look back in the last 2 decades or so and refer to this as been a terrible way to invest your capital. And that's not necessarily the reason why you should be avoiding this. It's probably the reason why you should be in your radar is the fact that it's been underperformed for so long. The mining industry tends to do very well during inflationary times. And the reason for that is because it's got an inherent pricing power in their business model. As you see metal prices rising, despite the fact that cost rises along the way, you tend to see those companies do quite well just because the metal price is increasing, creating that pricing power that improves the multiples over time. So this is the time to own those things, in my views. If you believe we're in an inflationary era, this is certainly the time you want to be focusing on in that part of the industry. Now, what to own? Well, basically we're in the process of seeing a lot of changes in terms of leadership as well. The businesses right now, in terms of the top companies, they're not really focused on exploration. They're not focused on production. They're not focused on resource growth. They're paying back dividends. They're basically doing buybacks. So essentially, they're not really being mining companies. They're being overly conservative. All those are signs of the overall industry being at its bottom. But we've been there for the last, 3 years or so. So if you ask me where the major opportunity really is, probably not in those companies, but potentially in the new leadership that will be emerging here and creating those new vehicles, those new companies that are likely to become the new Newmonts and Barricks of this cycle. So, there's definitely no shortage of things to be doing. And the distress opportunity to me is I see that as as an opportunity, not a problem. And but there's a lot of lack of liquidity, difficulty of finding access for capital, labor. Again, no shortage of issues, but that's where you find most of the opportunities too.
So, it's interesting you say that. And obviously, you're looking for alpha in the way that, you're trying to find out which companies are going to perform well. But I kind of look at it a little bit differently. I mean, the industry has been so beaten up that I don't know what the number is. Maybe you know it offhand, but like I can't imagine that the entire market capitalization of the entire precious metals mining business has got to be like under $500 billion. Is that somewhere in the ballpark? Do you know that number?
Yeah, I believe it's actually twice the size of Apple alone market cap. And in fact, if you think about including, you're just talking about gold. Now, if you think about the overall metals and mining, including base metals and other things that also look very interesting, what's the weight of that in the S&P 500 today? It's 0.7%. For every dollar going into the global equity market, only 3 cents are going to metals and mining. And so I'll ask the question again. I mean, how do we go from green revolution, reshoring, developed economies, improving capabilities of manufacturing and improving even the electrical grids and all those policies that we were talking about, and even defense spending, which also requires materials like metals and mining. How do we go from that without making this industry a lot more relevant? And so there's an asymmetry embedded to the thesis here. And so to me, that also looks quite attractive.
Yeah, well, I think that even though you're looking for great opportunities, I think the opportunity just comes holistically because when some of these money managers are forced to allocate into this industry, there just isn't enough stock to go around, and they're just going to start hammering those ETFs and other things, and it's just going to be indiscriminate buying to get a certain percentage allocation into a portfolio. And obviously, there'll be a few winners when you find some good fundamentals and things like this. But, it's going to be interesting to see, if gold in 2024 makes that break to all-time highs and holds it and heads higher. I mean, at what point do these equities start getting the love that they just have not been getting for years?
Well, there's a lot of things to unpack there, but you think about it, there's a reason why we've been able to buy companies today with, trading at 1x free cash flow sometimes. And there's a discount in the market currently in South American companies relative to other regions. And the discount is really jurisdiction risk and political risk and other things. And markets will, as you know very well, markets will change the way they prioritize how to value a company or an asset overall. And today, that kind of jurisdiction risk has been much higher in that prioritization. Now, where I think things are going to shift is that the discount between those companies, or the disconnect of valuation of a company in South America versus North America, is that despite the jurisdiction risk, what you can do in South America right now is you can get a project into production much quicker than in the US or Canada. And so, given this demand that we have for metals that is likely to be even bigger in the following, call it 5 years or so, I think that the gap of valuations are going to get squeezed as well in a big way. So, this is why I've been, kind of laser focused in that region, especially in metals and mining. Another thing that's been happening that is quite interesting too is the change of most of the major companies, and I'm referring to the top 10 major companies in gold space. They're looking to sell some of their assets. Actually, they've been kind of spinning off some of those assets in different ways, either distress selling or just being forced out of some of those companies or some of those projects, and all over the world. It's not specifically to North America or South America. And if you looked at global production for gold, it's been in a decline over the last years or so, which also coincides with bull cycles for gold. We saw a long-term decline, over a decade decline of gold production globally back in the 70s and also in early 2000s. And guess what? We're just starting to see another one here today. Now, the reasons for that are quite different. The reasons why majors are not so focused in gold specifically and looking for copper and other things is shareholder pressure for the green revolution, battery metals, and other things. When we talk to institutions, none of them want to invest in gold businesses. They all want to invest in lithium and copper and other things. Although copper looks really cheap still, lithium is the first thing that comes to the agenda when you talk to an institution about metals and mining overall. So, or even uranium. But, the focus in gold is been kind of diminished in particularly coming from the major companies. And so, you can buy one of those assets from those majors nowadays and create those new vehicles that focus on exploration for really cheap. And so this is where I'm coming from in terms of spending most of my time, at least, because I honestly think the rest is basically noise, and I have never seen a kind of an opportunity like that in my career. So to me, this is sort of a generational wealth kind of setup that I want to focus all my time and effort here now.
All right. Well, listen, Tavi, I can't thank you enough for joining us. And let's not make it 4 years before we have you back again. Let's do this more often. But listen, before I let you go, can you just let all our listeners once again know where they can find you and follow your work?
No, thank you very much for having me. Look forward to having other conversations. They can follow me on Twitter at Tavi Costa or in our website, 𝗬𝗓𝗏.net, if you want to know more about what we do. But thanks again, Patrick, for having me. Looking forward to keeping in touch.
Thanks, Tavi. Have a great one, bud. Okay, before everyone signs off, I need to remind you that I believe today is an extraordinary opportunity to protect your portfolio from potential market volatility in this coming 2024 year. It has rarely ever been cheaper to insure the downside risk of your portfolio. In light of where we are in this economic cycle, this topic deserves a much better explanation than a quick mention on this podcast. That's why I'm hosting a special free webinar to go extensively into detail why I think this is an opportunity our listeners must understand. I'm hosting it on Monday, December 11th at 1 p.m. You can register at bigpicturetrading.com. Thank you for tuning into the Market Huddle Plus. Next week, we'll return with our full show. See you later, everyone. Cheers.